All right, yield nerds, it is time to do another yield Super Bowl because a lot has changed just in the last few weeks. The year has started with some very strong improvements in the stock market. And then we've had the Fed meeting and rate setting changes and so on. So the question is, what is the best fixed income investment today among available options? So let's start digging deeper. My usual disclaimers, this is not investment advice, it's education. You make the decisions. I am not a wealth management advisor. I do not have merchandise to sell. And this is not politics, it is purely education. So let's talk about how this particular episode is organized. We're going to review what I call the yield Super Bowl. If that is not a term you're familiar with, you may want to look at some of the previous episodes and understand how we organize the show. There is a playlist where you can pick off yield Super Bowls and just watch those to get an idea. We will be setting up individual securities, fixed income securities in a certain way so we can compare them easier. And then we're going to look at what the previous yield Super Bowls were. And given that we are headed to a real Super Bowl in the National Football League, kind of makes sense that we do a Super Bowl here as well. And then we're going to say, what do you do over the next 2 months based on that information? All right. The yield Super Bowl, as we call it, is taking some of the most popular fixed income securities, such as treasuries, agency bonds, munis, and corporates, and most importantly, stacking them up in such a way that we can compare them. In other words, we're not going to compare a 3-month treasury with a 20-year muni bond because the durations are different. So where available, we're going to compare a 3-month treasury against an agency bond maturing in 3 months, against a muni bond maturing in 3 months, and a corporate bond maturing in 3 months, and then do that for each duration over time. But one more thing, not all of these are taxed equally. So you may think you're making a certain yield, but at the end of the day, the tax treatment is different for each of them. So we're going to account for that as well. So let's talk about how we do that. We are going to compare everything on a pre-tax basis. What I mean by that is since treasuries are state tax exempt, we're going to take the existing treasury yield and bump it up by state taxes. And we're going to take agency yields only for specific agencies that are state tax exempt and bump those up. For munis, we're going to bump them up by a federal tax amount, which, obviously is a bigger number. So hopefully you have a good advantage. Hint, hint, doesn't always happen. And corporate bonds, we're going to keep the yield as is because they're both state and federally taxable. So now we can compare all of these securities on the same playing field, so to speak. So that is what we call the yield Super Bowl. If you're not familiar with which agency bonds are taxable, which agency bonds are not taxable, feel free to watch the relevant episode that gives you that information. If you also are not familiar with the fact that some muni bonds are actually taxable in the state where it's issued, also a previous episode you want to look at. And last but not the least, I believe in using the effective tax and not the marginal tax. And there is also another episode where I discuss why I use that. Having said all of that, let's get to how we came to where we are today. Quick reminder, I am discussing taxes. I am not a tax accountant. Do your homework. So where were we in terms of the previous yield Super Bowls? You may remember that in September 2022, which is almost 6 months before today, we compared corporate bonds against muni bonds, and we said in the very, very early stages, if treasuries were there, treasuries would be the winner. Agency bonds took the crown in the 18 months to 2 years, all the way up to 5 years. And then corporate bonds had pretty good yields, again, on a pre-tax basis. Corporate bonds were good in the 10-year and munis all the way in the 30-year basis. This is September 2022. Then we looked at the same thing in November, and by now we started tweaking things a little bit. Because if you remember, there are AAA, AA, single A, and AAA is the least risky, and single A is the most risky, and this is all in the investment grade side. There is no point looking at the yield of a single A when you could look at the yield of a AAA and a AA as well. So what we did is we said we are only going to pick the least risky muni bond and the least risky corporate bond and compare them to treasuries and agencies so we can give the greatest advantage to corporate bonds and muni bonds. And even with that significant advantage, in November of last year, you can see that treasuries were head and shoulders above munis and corporates and agency for that matter. Agency bonds generally they don't issue really short-term agency bonds. And agencies kind of took the crown, and there were some pretty good corporates. This is as of November. And as the duration increased further and further, the munis took over, and towards the very long tail, munis offered the best yield on a tax adjusted basis. But treasuries and agencies were the winners in the low duration area. And now the question is, how are we doing today in February? So let's look at that. Treasuries not only are the winner, they are the winner by a lot in the 3 and 6 month duration. The gap kind of narrows in the 1 year mark, but even then, treasuries continue to dominate. There is a very simple reason for that. The federal funds rate is continuing to keep up, and therefore, the rest of the market is just not able to keep offering higher and higher interest rates, so they are lagging behind. And as you can see, the gap between treasuries and muni bonds is now astoundingly high. Remember, this is adjusting for the federal tax rate of 28%. So even if your federal tax rate was 28%, which many of us, you will have to look at your own tax returns and look at what the marginal tax is, and you'll have to see the episode to calculate that. But this is giving a great advantage to muni bonds. And even with that great advantage, there is no contest for munis all the way until the extreme long duration. Not only that, the advantage of treasuries is astoundingly higher. Even agency bonds can only make noise around the 2 and 3 year mark, and corporates around the 5 and 10 year mark. The moral of the story is the Fed intentionally is increasing funds rate and kind of making all the other fixed income securities far less competitive. So in a duration less than a year, pretty much almost less than 18 months, you really have nothing other than treasuries to look at. In the durations from about 2 years to about 5, 10 years, agencies dominate. And in the 5 and 10 years, there are some corporate bonds, and you do your own math on whether those corporate bonds are the right ones, and I'm not going to pass judgment on that. But munis at a 28% marginal tax rate make a difference only at 30 years or 20 years. And so the question really is, if you know interest rates are going up, why would you buy 10 and 20-year duration bonds? And that's a question you have to answer. Common sense would tell you just wait until a little bit longer before you buy extremely long durations. All right. So what did we observe? In the short and medium term duration, treasuries win by a really big margin. In the medium to long term, agencies win. And if your federal tax bracket is 20%, 28%, or anything lower, at the moment, muni bonds really don't have a good offering for you. And if your federal tax bracket is really, really high, your effective tax is really, really high, even in that scenario, corporate bonds may be a player at around 20 years. Munis really aren't catching up with offering higher yields as of today. Then the question is, where do you go from here for the next 2 to 3 months? Let's look at some statistics. This is the yield curve. And if you look at information, if you Google Treasury yield curve inversion, you will see that this is almost the worst inversion in the last 40 years. And that's a pretty stunning statistic to throw on the table. During the oil crisis of the 80s, you have to go that far back for short-term interests to be that much higher than longer-term interest rates, which is really the difference between the 10-year and the 2-year. And so the inversion is extraordinarily high. And what that means is short-term duration is really where most of the attention is going, and people are running away from the long-term duration. Some argue this predicts an imminent recession, others say it doesn't. At the end of the day, if you can make risk-free or relatively risk-free 5% returns, it seems like a no-brainer to me, and you do your own decision. So look at this year. This year, in the first few weeks of the year, in the first 6 or 7 weeks of the year, the S&P has gone up by 7%. As a matter of fact, it went up by as much as 11% and kind of dropped a little bit. You would think the S&P going up means interest rates should come down. The Fed should be signaling, hey, I'm going to let some pressure off, trying to choke the economy. But in reality, that is not what is happening at all. The blue curve here is the yield curve from September. The orange is October. As you can see, yields are increasing, both in the short and in the long term, and then something interesting is happening. People are running away from the longer duration, and the short duration yields are so high that nobody wants to hold longer duration. They are dumping it, and so it's available in the market in plenty. However, interest rates in the short term are indeed fantastic, and the Fed is signaling between January and February that it is business as usual. Meaning, even though the commentary is, I see disinflation and all this kind of stuff, they are proceeding on the same path as before, and as a matter of fact, longer term interest rates are dropping and not higher. And these are really longer term yields and not interest rates. And so there is a signal that is being given. Somewhere between 2 years and 3 years is where the market is willing to say, hey, you know what, maybe the right time to start buying longer duration is coming. And we'll talk more about that as we discuss next steps. However, one of the big next steps is indeed the debt ceiling. So bottom line is somewhere in there is a head fake. Either the market is dreaming into thinking the economy has been fixed, disinflation has begun, and it's going to go up, up, and up, or the Treasury continues to go in its direction even though they plan a U-turn. You do the math on which one is more likely to happen and who is more likely to be true, and chances are that there is a head fake coming up. So in the midst of all of this is a big, big problem, which is the debt ceiling. If we do not resolve that, and there are proposals from the left and the right of what to do about the debt ceiling, and you can Google and see what kind of proposals are there, and you can read that and see whether they are proposals that indeed will pass through the House and then through the Senate. And if you, like me, think there is a chance of some turbulence, I would probably stay short duration and get a whole bunch of treasuries. I'm going to very humbly sit here and say the S&P may indeed be going up. This may be the beginning of a fantastic bull run, but maybe just wait and see how the drama with debt ceiling goes. If you really are brave, we saw that cross between the 2-year and 3-year, where more and more the 3-year yields are dropping. And so you may want to buy a little bit of 2-year, a little bit of 3-year yields just to kind of protect yourself in case there is a head fake in the other direction. However, odds are if you waited about 10 weeks, unfortunately, the division between the two parties is going to create chaos, and there probably is a very interesting yield opportunity coming up. And what that means is there may be some level of panic, whether it happens or not, whether the debt ceiling is resolved right away or not, some level of panic over the next couple of months, and a great yield opportunity. If any of this is not clear to you, if you want the underlying spreadsheets behind any of this, feel free to contact me. Get your seatbelts on, yield nerds. The next 10 weeks are going to be nuts. Here is my email, yieldnerd@gmail.com. Feel free to contact me. Good luck.